Welcome to the Purposeful Wealth podcast. I'm Jonathan Gibson, Managing Director of Wells Gibson and co-president of the Scotland Committee for the Chartered Institute for Securities and Investment. This is the podcast where we explore how to create financial peace of mind and secure everything that you value so that you can live with clarity, contentment, and certainty. In today's episode, we're asking, do emerging markets still deserve a place in your portfolio? Well, let's take a closer look at what we call the emerging market pendulum. After a decade where US equities have dominated, it's easy to forget that good investing isn't about chasing winners. It's about preparing for a wide range of possible futures. Now, emerging markets, or EM, have underperformed developed markets for quite a while, especially when we compare emerging markets to the United States. And that's led some investors to question their value. But here's the key insight. This underperformance is not a reason to abandon emerging markets. In fact, it's a reason to keep them. Why, you might be asking? Well, because emerging markets are expected to deliver higher long-term returns. That's the trade-off for accepting more risk or more volatility, political, economic, or even governance-related risks. Investors expect to be compensated for those risks over time. And history suggests they usually are. So since July 1989, emerging markets have delivered around 0.7% per year more than developed markets. Now that might sound small, but over decades, it's significant. But the ride isn't smooth. Let's be honest. The journey isn't always smooth. Emerging markets are more volatile than developed markets. They can drag down your portfolio some years, but they can also lift it in other years. What really matters is remaining invested. The investors who remain through the ups and downs tend to be the ones who benefit over time. Diversification is what we often think about as the only free lunch that there is when investing. And it is our best defense against uncertainty. By owning both developed and emerging markets, you reduce your reliance on any single region and increase your chances of capturing returns whenever or wherever they happen. We often show a chart to clients that plots performance across the United States, developed international markets and emerging markets. And what stands out is how erratic each region can be. Yet when combined, the diversified portfolio sits right in the middle. Not too hot, not too cold. It helps avoid the twin dangers of fear of missing out and regret. And that's why we stay diversified. So in closing, emerging markets might not have had their moment lately, but they remain a powerful contributor to long-term success. They offer return potential, they provide diversification, and they give you exposure to the world's fastest growing economies. At Wells Gibson, we continue to hold emerging markets in our portfolios because we believe they do help our clients ultimately to live their life, the life that's important to them, and helping them to live purposefully with that clarity, contentment, and certainty. So once again, thank you for listening to this episode of the Purposeful Wealth podcast. If you found this helpful, please do share this episode with others and leave a review. And if you'd like to find out more about how we invest and what systematic investing is or evidence-driven investing, please visit wellsgibson.uk. See you next time. Thank you.